Well, I think that I guess what I would say is that they expect too much from their initial research effort, that they think they can get all the answers. A former boss of mine says, you really don't know the company until you know the names of the guys in the mailroom. So you may not have that down the way you should. You should be modest about how much you can hope to absorb. It's a continuous process, but it's not one that can be accelerated too much. And of course, it's connected with something you've probably gathered, which is that, an old friend of mine who was in a number of fields with me, both environmental education and investing, New England guy, used to say, you never go broke making a profit. Well, I don't really agree with that. And anybody who's looked at their portfolio figures out if you own 20 names, or 25 names, it's going to be 3 or 4 of them that have given you the most percentage of your return. And so in prolonging the experience of getting your hands around the company, I think you've really got to go big at certain times. And that would mean, putting up to 15% of your, it's an interesting question. Do we put 15% of our gross long exposure or 15% of our net exposure? I would say in general, we've been leery to go above, say, 8 or 9% of our gross exposure on the long side, but it could be as high as 12 or 13 or 14% in terms of our net exposure, particularly in those companies that we've determined to have rather little downside or no downside and moderate upside where we might get a surprise. So I guess those would be the two things. Not to think you can learn it all in a minute, and not to think that you can get the kind of performance year over year without having a concentrated portfolio.